Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. The case for a chat today, amidst all that's happening on the micros as well as the macros and locally and globally, we asked the question whether the markets will remain range-bound amidst the pre-poll jitters or the pre-poll volatility. Is China growth bottoming out, and does it have ramifications for the commodity sector as well as flows into EMs other than China? And is consumption looking like the trend is changing from the K-shaped growth that has happened for the last 36 months? Could staples and rural consumption make a bit of a comeback? We pose all of these questions to somebody who thinks deeply about these things. Maneesh Dangi, founder of Macro Mosaic Investing and Research, joins us right now on the show. Manish, great having you. Thanks for taking the time out. I hope all is well. How have you looked at what's happened on the macro landscape and risk assets over the last 3 odd months, Manish? Because India has got this specific period of pre-election volatility, which is evident, but the world is not bereft of volatility either.
I think over 3 months, Neeraj, there are two, maybe three, you could say, have been surprises to markets. One, of course, almost all three inflation print in US have been somewhat disappointing. We can discuss this in detail. They were not as bad as they appeared on the face of it, but yeah, they were sort of, at least the disinflation in US actually was not there. And so that was a big surprise to market. That led to, of course, major backup in US yields. On the growth side, while GDP number in US was weak, but I don't really sort of give much credit to GDP. There are better ways to actually track, at least from a market standpoint, what growth is, and it's decent until the last NFP number. I think growth has been decent. What is actually, from a growth standpoint, turned out to be somewhat of a surprise that there is some sort of, I think China is beginning to recover, and it sort of now starts to appear to me that pretty much entire world, so industrial cycle as well as, would you say even consumer cycle actually very likely bottom at some point in time. So even though I kind of believe that US would slow, but rest of the world could have actually bottomed, and I'm not talking of India here, and because India is more adjacent to US than China. So that's the second big thing. Third, of course, what happened in Middle East, was a surprise. Again, I consider oil as an insider, and so oil got the Middle East ahead of when we got to know in newspapers. And oil also again got it to the extent that now we know that it's actually healing, and at least the tensions would not lead to the kind of supply disruption. So since you asked me about 3 months, sort of whatever comes to my mind, these are the three major surprises, I would say.
No, what I meant by 3 months was that because in the last 3 months, so much has happened. So which is why I was trying to get the recency bias into the way. Let me probe the rates point a little bit, Manish. A lot of people were of the opinion that this was a year of rate cuts, and rightly so. Until the better part of last year, that seemed to be the case. The narrative seems to have changed a little bit. I was in the US the last 6 days, and the consumer out there is spending like there is no tomorrow. I mean, it seems difficult to pencil in that, yes, maybe the shelter prices come off at some point of time, but until that happens, maybe inflation doesn't come. But the consumer is not certainly bringing inflation down. So my question is, do risk assets get impacted disproportionately if we do not see rate cuts this year? Or do you believe now that is something that the market is kind of working with parallelly, that we might see a year of no rate cuts also? That is a possibility.
No, it's certainly possible. Like if actually growth doesn't sort of slow down, though in the election year, it's very, very difficult that rates perk up from here or even stay here, because it's pretty toxic. And these rates, a lot of things, while you argue about consumer, frankly, on high streets that you go to, you would never see a slowdown ever of Paris and New York. But there are sort of chinks there, and there are the small firms layoffs have happened. Of course, last year, 1.5 years, you had IT firms lay off, and they have not sort of taken anyone back actually. So in a sense, the labor market, while very tight, but the cognitive labor, if you could think of, the top layer of the labor, top quartile of the labor, that market is pretty loose. So and sluggish, so to say. So I kind of think of things more from a cyclical standpoint that, given that US had a very strong upcycle, the next move at some point in time would be sort of, given that these business cycles tend to be 3-5 year boom bust, uh, typically what happened in Asia, Europe, didn't happen in US and at some point in time would play out. So my sense is that it is sort of a more of a timing thing. Yes, even I was of the view that June, July, you would begin to see uh, unemployment number rise, NFP numbers sort of worsen significantly. That hasn't happened. Last NFP number was bad, but I mean, I was actually more thinking we'll get to 1 lakh, 125,000 NFP number. That's not happened. I think, Neeraj, that in maybe it's sort of delayed, but it will eventually, the economic slowdown because of high rates, would kick in. And that would mean that eventually you will have rate cuts. So purely from a bond investor point of view, I argue that frankly, these 3 months, 6 months postponement do not matter. I guess there is a lot of risk premium, excess risk premium built in bonds. And therefore a bond investor, it's still a time that, he ties this risk.
Okay. Maneesh, the other aspect is China, and I know you think about this very, very well. I just would love to understand whether growth out there is bottoming out. The parallel question that I have there is a borrow that I have from a Morgan Stanley note today, wherein they are saying that yes, China is growing, but with no material improvement in inventory levels and spreads, especially for steel and hence profitability, we believe the outperformance of some of the metal stocks and steel stocks in particular might be overdone because the valuations are no longer as cheap. So two-part question. One, on China growth, what is your belief? Actually, three-part question, sorry. One, on China growth, what is your belief? Two, is that growth imperative for emerging market flows to start coming back in meaningful way, and will India benefit there? And three, what happens to commodity linked stocks? Because there has been a bout of outperformance. Will that come back again?
So the second question first, that emerging market, of course, are more adjacent to China. And if you see, while, let's say, last week global PMI prints also suggest that as if they've had a relapse of sorts, but EM PMIs have, like that of India, has sort of been very, very strong. So my sense is that is telling you something, that they are experiencing what China is going through. They're a better way to gauge China than Chinese data itself. My sense is that it's likely that China, after a good 3.5 years of sort of purge, has bottomed. Let's say if you look at retail sales of China, it's pretty bad, 2%, 3% growth. So, historically, they were in teens. So it's, in some sense, it's still, various parts of China are still struggling. But a lot of structural reforms, the pivot to something else relative to property and real estate, a large part of it, is as at the fag end. And if I were to bet on a 5-year, 3-year, 5-year, 10-year view relative to expectations, I think China would surprise more positively versus I was China pessimist, for long in terms of growth until 2019-20. But I think, consensus has shifted to left, and I guess China wouldn't do as badly. China's sort of technological advancements have actually surprised everyone, including me. And also, please understand that China has a degree of freedom that it can do Japan to its currency and actually grow and stimulate itself. It can do what US did in 2009 or 2020 to re-stimulate its retail sales and consumer. It's not doing all of it. So there is a protracted recovery, but the degree of freedom with the policymakers sort of both at currency and rates level stay there. So that's on China. Then sort of you asked, I think, on commodities, again, as I kind of believe that most specifically copper, but generally metals are good insiders of what's happening in China, and they're also telling you at a from purely from a price action point of view for the last few months that they know something that most probably stock market didn't know there, and now even stock markets know that they've bottomed. So now would copper rise from sort of and rise, or other metals will rise? It is a lot of things about valuation. But if you're trying to sort of gauge China, then all of them are actually telling that yes, China must have bottomed.
Okay, okay. And Maneesh, just maybe I missed it, but just trying to understand, because you look at flows also closely, I believe. A lot of people believe that EMs as a basket and even India will benefit when China flows start, as opposed to thinking that flows moving away from China will move into India. What is your thought here?
Yeah, so Indian flows are adjacent to like Tina in a sense. If let's say you can't go to Malaysia, China is when within EM India always seems like an oasis. And if China were to become attractive again, and we've seen it in the past, emerging markets and even China sort of are way cheaper relative to India. Even you adjust for ROEs and stuff like that, its growth isn't as bad. And so you kind of get similar businesses in China industries at much cheaper valuation. So if, let's say, FIs were to pivot back to China, it would come at a cost. In aggregate, flows actually, Neeraj, don't rise dramatically outside of a small hedge fund flows. The investor flows actually are a sort of a set pie, and it's actually the zero-sum game. If someone very large like China and EM as a basket is gaining, it is gaining at our cost. And so I would never celebrate, China, retrieving flows back from the FPI pool. It's not necessarily good news for India.
Got it. Okay. We spoke a lot about global. We got to talk a bit about local as well. Just before we start doing that conversation, I think something that might add to it is something that REC had to say on the con call today, and my colleague Harsh has some of the key details from that con call. Harsh, take it away.
Well, Neeraj, absolutely no impact with regard to net profit, no impact with regard to net worth, no impact with regard to book value. That's what REC's interpretation of these guidelines are. What they are quoting is they are suggesting that they're quoting the RBI with regard to certain discussions they've had with the RBI and suggesting that no state government-backed projects will be covered by these regulations. That's what they are essentially focusing on. What they are suggesting is just about 20% of their portfolio might get impacted, and that too only the tier 1 capital with regard to these projects, or rather this quantum of 1 lakh crore of their 5 lakh crore book will get impacted with regard to tier 1 capital. That's the only impact which will go through. You can see the stocks up and away. We spoke with the management as well a few days back. They've guided for very strong growth, 10 lakh crore plus in terms of their AUM, and 23 to 24% PAT compounding is what they had guided us for.
Okay, thanks for that, Harsh. And remember, some of these stocks have done really well after getting punished the whole of last week on the belief that there is going to be the draft consultation papers are negative, or rather not on the belief, on the assessment that the draft consultation paper that the RBI had released with regards to the new norms would be negative for some of these stocks. Maneesh, it's the pre-poll season, and we're seeing that bit of volatility coming into equity markets by and large. A word, one, on that, and two, on this whole wealth creation that PSUs have done over the last 12 to 24 to 36 months. Now, naysayers argue that, hey, these stocks will never be completely free or autonomous. There will be interjections, and those may disrupt the party. I would love to know, what do you think about both of these aspects?
So the poll, of course, I kind of think that, what matters the most actually, Neeraj, is not who the next ruler is. And we sort of know who the next ruler, most likely incumbent, is returning. What matters, of course, is if the sort of industrial policies, economic policies, which are alternate from what the incumbent policies are too divergent. and at margin, if the incumbent is losing somewhat, not it's still winning, but still losing somewhat, it has a large influence on the policy construct of the future. Now, we all have to admit that the alternate camps in India, the the divergence has never been as much as it is today for last 30 years. The mandate that the opposition wants is to do things which is so different from what is being practiced in India in terms of economic policies and very likely in terms of industrial policies, that sort of any chink there, any risk there would induce extraordinary amount of risk of sides or volatility. So I think given that now we are halfway done in poll season, its market is, at least in Bombay, the assumption is that it is no risk at all. It's actually now coming close to a point that okay, it could be some risk in some form in the spectrum of possibility, and therefore it's baking in. That's how, Neeraj, I think of poll season. I don't think people still think that there is any major negative surprise in terms of who forms the government, but they could be now shaken that no, what if it's not the kind of government that they thought they would get?
Maneesh, some people tend to take advantage of fear. Some people believe that the fear that is coming in is coming with valid reasons because the optimism was a bit exaggerated. Which camp are you on if you are in either of these two?
So, I kind of, in three steps, if let's say incumbent were to return, last 1 weeks of, sort of fear harvesting would be undone. If incumbent were to sort of fall short of something like, let's say, very lowish number 220, then you ought to play a major inflation and redistribution trade in India, which will mean favor property over real estate, favor FMCG over tech, or other sort of growth sectors, favor non-infra versus infra, favor private versus PSU. So that sort of trade will return. At 250 plus, so somewhere between 250 to 285 for BJP would mean, small 5-10% sort of cleavage there, and things are back to square one, with a little bit of a dilution in terms of the policy construct, which were especially the industrial and tax policy construct. So that's how I would kind of think of it in terms of the reflects to the outcome of elections.
Got it. Now, interesting point that you made about this thing as well, FMCG or consumption, if you will. The last, post-COVID at least, we've been seeing not just in India, maybe across the world, but definitely in India, this bit of K-shape wherein rural has largely been hurting, urban and premiumization even more has largely been benefiting. I would love to understand, Maneesh, you are a believer of cycles. Do you believe the cycle at some point of time naturally would undergo some bit of change? Can rural come back, or is that difficult to pencil in right now?
It's very, very likely that if you were to take a 1-2 year view, it's very likely that the term of trade adjustment, both from a policy as well as growth standpoint, would go in favor of hinterland. And those proxies, in businesses, one such is, of course, a stable business or two-wheeler, and many such, would actually likely do better than the alternate, which is urban proxy businesses. So I'm sort of purely from a cyclical standpoint, it's for far too long. One part of the economy has done really well at the cost of other, I would say. I guess it should change. Now, if your question is if it is still there, no. I mean, you don't really hear from Unilevers and such likes. The volume growth is sort of pretty dismal. I think one good news is that, let's say, NREGA jobs actually year on year are contracting now. So that's sort of maybe telling you that there is some traction. It could very well be that the entire labor migration may have reversed, and that may be a cause, because I'm not very happy with the real wage growth of rural India yet, especially in agriculture. So it's still mixed. Again, as we talked about bonds, if you're taking a 2-year view, very likely these things tend to heal themselves, or policy induces healing. So it's very likely that over next 2 years, the other side of the K would likely do well. If you're a 3-month guy, you still don't have very strong data. But markets tend to look through this, and so because we are like half-life of that is already over, I think market at margin would begin to price this and trade this.
Thanks, Maneesh, for joining in today and giving us your thoughts. Really appreciate your time and your insights. And viewers, with that, it's a wrap on this edition of Talking Point. Thanks so much for tuning in.